Hey there. I want to tell you about how your financial statements can tell you a story that maybe you didn't know otherwise. So today I am presenting the Gay Ottawa Volleyball financial statements at their annual general meeting. I'm their VP of Finance, and so that's part of my role is just to present those financial statements. And so today I was just spending a bit of time not getting familiar, but preparing what I wanted to say, because I prepared the financials, so I'm familiar. I just wanted to be clear about what it is that I wanted to talk about and the story that I wanted to show them. And I'm not going to talk about their financial statements because obviously that's not okay. That's confidential. But I think that it's the idea of getting stories from our financial statements is so important. When we look at our financials this year, all of our financials, or I should say most of them, are going to tell some sort of story of COVID. There's going to be an impact from the pandemic. Some of us are way busier. Some of us are not. Some have like a weird dip at one point. Like most people's financials are going to have that embedded in there, and it's going to be part of the story this year. But that won't be the only story. And I think it would be really easy to just see those financial statements, look at those numbers and be like, oh, well, COVID, and move on. But I would encourage you to really dig deep this year and look past the impact that the pandemic has had and to see what else has happened in the business, because the financial statements are really they're a really good place to ask questions about your business. So for example, if I was looking at a set of financial statements and I could see that this year versus last year, the company had significantly more inventory at the end of the year, I would say, why? Why is that? I would also want to look at their cash flow if that was the case and say, are they struggling from a cash perspective? Because if you have more inventory, that means that your cash is tied up there, right? You can't get that cash back out until you sell the inventory, which depending on your sales cycle could be a short amount of time, it could be a long amount of time. And so that would direct me to ask a question and say, hey, what's changed about your inventory policy? Like, did you get a really good deal on something maybe, or has your supplier terms change, so maybe shipping costs more, so you're better off getting a larger shipment or something like that? Whatever the answer is, I think it would be a good idea to examine that. Some other examples might be the gross profit number or gross profit percentage has changed significantly. So if I'm looking at revenue and we see like maybe revenue's doubled and we're like, yeah, revenue doubled this year, like killing it out there, I would then want to look at your cost of goods sold. Like, what did it take to make those sales? Because if your cost of goods sold has gone up by more than twice as much, maybe we have a problem. Not maybe, we probably have a problem. And that's a question that I would want to be asking and just say, hey, like, yes, revenue went up, revenue doubled, but cost of sales went up at a rate that I didn't expect based on the relationship to revenue. So revenue minus cost of sales gives us gross profit, and gross profit divided into revenue gives us our gross profit percentage. So if your gross profit is like consistently 50% of revenue, so you sell $100, cost you $50, you have $50 left over for expenses, then suddenly this year, maybe cost of sales is 25%. So now you have $75 left over for expenses. Like, that seems like a good thing, and maybe it is, but what happened there? Like, why was there such a big change? And in that case, like, maybe the supplier started charging less, which is rare. That rarely happens. But maybe you made a decision that the materials that you're going to use to create your products don't need to be as high of quality. Or maybe you were able to find a different supplier that allowed you to charge, or that they charged lower prices, and so you're able to gain bigger profit margin there. Or maybe it's, I don't know, that's kind of the two main ones in terms of cost of goods sold. I'm sure there are lots of other examples, but those are the two main ones. And so really understanding your your relationship between the numbers on your income statement and on your balance sheet. Because looking at one number, looking at revenue and saying, oh, company grows $200,000 this year, well, that doesn't really mean anything. What did they gross last year? How much did it cost to create those sales? If you had to buy a new asset, were you able to do it with cash in the bank? Did you have to take on a loan? Was it maybe a bit of both? Like, what were the decisions of management and how did they impact the company is something that you can take from the financial statements. And as an accountant, when I'm talking to small business owners about their numbers, it's a conversation. It's, I can see there's changes and I have questions about those changes. And then the small business owner gives me, operating decisions or operational things that have happened that support that finding or support their numbers. And we can chat and say, hey, okay, so you decided to buy less expensive cost of sales, like materials this year. How has that impacted your customer retention, for example? Are people not buying as much because it's not as good quality, or has it not really impacted the overall quality of your merchandise? Like, that conversation becomes the basis of our strategy sessions and the way that we can look at the company holistically, but then also say, okay, where is this company going? What are the goals of the small business owner, and how do we make sure that we get there? Because accomplishing short-term goals and sacrificing long-term goals is never good for the life of the company. In a lot of cases, when you see companies that go under very quickly, they seem like they're doing very well, but they go under very quickly. It's because cash flow is an issue, and a lot of times they've sacrificed the long-term goals of the company for short-term gains. And so it's really about making sure that you're creating a good strategic plan for your company so that you can achieve both short-term and your long-term goals, and the impact of the decisions that you're going to make. So if you decide, I'm going to spend a little bit more of the cost of my materials, I'm going to charge a little bit more, like, how is that going to impact your company? So I think the starting point for these conversations, and something that you can do as a small business owner, is to look at your financial statements and really start to compare some of those numbers, like compare this year to last year, compare revenue to expenses, compare, your assets to liabilities, and that kind of thing. So I have put together a 5-day mini video series. They're short videos, so it's not like going to take you all day to watch them. And they're easy to understand, so you don't need a financial background to understand them. And it teaches you what each of your statements is used for and how to get the story out of them. So it's called Decode Your Financial Statements, and it does exactly that. It demystifies your numbers so you know what you're looking at, and you have a really good starting point to ask some questions about your company and build that strategic foundation for moving forward, because it's so important. I hope you're doing well. I would love to chat more with you about this. Please leave your questions, comments, all of it in the comments. I would love to chat more about it, and I'd love to help you out if you've got a question about your financial statements or what they mean, and sign up for that course. I'll see you tomorrow.